E-commerce entrepreneurs, what's up guys? It's Chris Rivera from the E-commerce Accountants. I hope everyone is doing well. Today we are going to cover what I think is the most underrated tax planning strategy that exists, and that is Roth retirement plans. Now, in terms of scope, this is focusing on the American entrepreneurs. Sorry, foreigners, we'll definitely have some more great value coming out for you guys, but this video is intended for the American entrepreneurs, both American citizens as well as entrepreneurs that are living in the US. The main reason why I'm doing this video is because I feel like so many accountants out there focus on pushing traditional retirement plans to their clients, whereas I think Roth retirement plans are actually far more beneficial in terms of return on investment. And the reasoning for that, I think, is that it's just easier to describe and demonstrate to entrepreneurs in general. So what I'm hoping to do in this video is to kind of demystify and simplify Roth retirement accounts so you can fully understand the tax benefits to both traditional and Roth. And full disclosure, what we push at our firm is always Roth retirement accounts. So what we're going to do is we're going to jump into my laptop here. What we're going to do is we're going to talk through a very simple example of a retirement account cycle, and we're going to break it down in terms of the implications between a traditional retirement account and a Roth retirement account. So here, very simple example. We have 2024, you contribute $10,000. Typically, that's how these plans work. Depending on the type of plan you have, you can contribute really anything between $0 and around $60,000 is the maximum through the end of 2024 here. That's not the exact number, but it's around that figure. And again, it depends on what type of retirement account you have, whether it's a SEP IRA, regular IRA, a 401k. We're just talking about all retirement accounts here in general. So in 2024, you contribute $10,000. Fast forward the next year, you contribute $10,000. Then over the course of time, the account, let's say, is invested in mutual funds or stocks, or it's self-directed, who knows what, it really can be anything. And it generates $30,000 of earnings. Well, over the life of the investment, you put in $10,000, you generate $30,000 of earnings based on the money that was in there. So you have $50K that's eligible for distribution. And if you pay attention to the years here, this is about 30 years later, you withdraw money out of the account. So how does this work under a traditional method? Again, when you hear traditional, think tax deferred. Well, in 2024, when you contribute, you get that deduction. Okay, 2025, you contribute, you get that deduction. As the earnings accumulate over time, they're tax deferred. So if you think about it, you got a deduction year one. Deduction year two, you have all these earnings that there is no income or deduction, right? It's tax deferred. Then when you pull the money out in 2055, you have income of $50,000. So this is the tax planning strategy that a lot of accountants push, because when they're doing your taxes, they're giving you the shiny object syndrome approach where they say, hey, you're going to get a $10,000 contribution now. You're going to get a $10,000 deduction right now. You're going to get a $10,000 deduction in 2025. But what they don't do a good job of describing to you is that over the course of time, as you generate earnings in the account, yeah, you will not have to pay taxes. But when you pull that money out, you will have to pay income taxes on the full amount. So this is not a great tax planning strategy, in my opinion, because all you're doing is you're deferring all of your income taxes. You have $50,000 that go into the account that you get a deduction for. Then you get $50,000 of taxable income when you take the money out. So you're net zero from a tax standpoint. Okay, so when you hear traditional, think tax deferred. Roth, when you hear Roth, again, think permanent difference. Okay, so let's look at this one a little bit differently. When you contribute in 2024, there's no deduction. Okay, when you contribute in 2025, no deduction. It generates earnings over time. You do not have taxable income. What happens when you take the money out? There's no income. So look at what happens here. You put $20,000 in. There's no deduction for that income. This is presumably taxed as you earn it, right? As you get a salary, as you generate business profits, etc. So you never get a deduction for this. When you pull the money out, you also do not pay income taxes on it. But the beautiful part about this is this $30,000 of earnings permanently is never taxed. Presumably the $20,000 that went in, right? This is taxable income as salary income. When it goes into the account, you don't get a deduction. right? When it comes out of the account, it's not income either. But additionally, this $30,000 of earnings is never taxed. This is a permanent difference over the course of time in terms of taxes. Now, I want you to understand that this is a really great tax planning strategy because we're talking small scale here on 2 contributions. What I'm going to do next is I'm going to show you a calculator that shows you just how large the tax savings can grow if you really optimize one of these accounts. Okay, so as promised, here is our tax planning calc. So I'll make sure I save this file in the show notes here. Just so you know, you'll have to create a copy so you can play with it yourself, just because I have to lock it, just so none of you guys who maybe aren't Excel wizards like me mess up any of the formulas. Very easy to use. The blue fields you can edit. These yellowish fields here are calculations, so do not touch any of these. And then the green calculations are lifetime tax savings for Roth, green like money. So let's go through traditional first. The way this works is whatever your annual contribution is, we do it fixed over time. So we did $10,000 like the example we just walked through. Earnings is exactly what it sounds like. Each year you have a carrying amount and it grows by the rate of return, and then your balance grows over time, your carrying amount. Now, if you have a traditional account, what are the tax implications? When you contribute $10,000, you get a deduction. What we're saying is the tax benefit of that is the deduction for your contribution times your tax rate. So each year you have negative $3,300, right? Now, what happens when the money comes out of the account, right? You're going to have 1.1 million in the account after all of these years. You obviously get a deduction for the amount that's being contributed in that year. But then also, when that money comes out, you take that carrying value times your estimated tax rate, and this is going to be your tax. So in that last year, you're paying $370,000 in taxes. So this puts down to a total of $274,000 in total taxes, okay? Between all the deductions, the tax benefit of the deductions, plus that last year of tax. In total, over the course of time, you paid $274,000, assuming a 33% tax rate. Let's take a look at what happens with Roth. So for Roth, when you do a contribution of $10,000, you get no deduction. Nothing happens. Nothing happens every year. The money goes into the account, nothing happens. What happens when you pull the money out after 3 years? Nothing happens, right? So again, think permanent difference here. There is no deduction when the money comes in. There is no income when the money comes out. So after year 30, when you pull out 1.1 million, you pay $0 in total taxes. So what's the tax savings on that? For a traditional account, you had $274,000 in taxes you've paid over 30 years. In a Roth account, you have $0. So the tax savings are quite simply $274,000. Now, here's where the fun part comes in. Let's say you are an extremely high performer over the course of the next 30 years, and you are at the 37% tax rate, okay? And let's say you decide to do $50,000 of annual contribution. What's cool about different types of retirement accounts, specifically backdoor Roths through a SEP IRA, okay? Backdoor SEP Roth IRA, you can contribute large amounts of money if you set up your accounts correctly. Now, if you do an annual contribution of $50,000 with a rate of return of, let's get crazy, let's call it 9%. Estimated annual tax rate, 37%. Look at the tax savings that exist. You can create almost $2 million in tax savings. And this is based on a permanent difference. How is this calculated? It's essentially your earnings over the course of time, right? Your earnings over the course of time is about 5 million after all of those contributions. So if I do the math here, 5 million in earnings times your tax rate, this is how you calculate your tax savings over time. So we're saving about $2 million here in total tax savings. And that pretty much covers our topic here. If you find this content valuable, please like, subscribe. If there's anything you want to learn in the future, feel free to leave that in the comment section below. And most of all, I wish you guys a prosperous quarter 4 here. Get after it, e-commerce entrepreneurs. Have a great rest of your day.